Hey, welcome everybody to Looking at the Markets. My name is David Modell. I'll be your host today with a very special guest, a repeat guest. He's always welcome on this program. He is a world-class volatility trader, market trader, and investor. He also knows about retail, such as brick and mortar stores, as well as online. So we're going to learn a lot today, and we're going to tell you about some opportunities as well. So Mr. Seth Golden, welcome back to the program, sir.
Thank you, David. It's been a little while now. I'm tickled pink to be back on your show.
All right. Well,
sure.
I'm very happy to have you here. I learn a lot. Okay, this is a little selfish for me too because I learned so much. So it's really great. And I remember that your website finomgroup.com, finomgroup.com, it's just been a blockbuster success since you guys started in late 2017. Before we get into market predictions and forecasts, have you been progressing with finomgroup.com?
So we started the day after Christmas in 2017. So December 26th, we launched, and we got flooded with subscriptions, registrations, et cetera, and it's just been growing ever since. Our memberships through 2018, we had 1,000 subscribers. And here in 2019, we've already grown that by 50%. So, we have 1,600 and I've even been, on Twitter, just panhandling to people because we have 1,666 members. Nice. And I need to get off of that 666 number. So anybody out there, subscribe today, please. Get us off of that 1,666. But yeah, it's been great. I mean, we offer so much content, whether it's video interviews, video discussions on the economy. We have a weekly, what we call State of the Markets, where we discuss everything that's affecting the market for this particular week and what you might expect going forward. I mean, everything from the macro to the micro, geopolitical to the central banks, everything you can possibly want. Pretty much every day, except for on the weekend, we have a daily market, what we call a daily market dispatch. It's basically your setup for the morning. What came out in the economic data, what's going on in the geopolitical realm, what are some interesting charts, some analogs that we're looking at, and some finer data points, every single morning. And then on the weekend, we have our, P de Resistance research report. It's our weekly research report. It comes out every Sunday morning. And you're talking about like a 25 to 30 page report, just depending on what's going on in the market. And we section it off really well. We start with everything S&P 500 related. Everything from the S&P 500 RSI to what the chart pattern looks like, what's overbought, where are we so far as overbought, oversold conditions, MACD, just everything affecting the S&P 500. Then we move into the week that was in economic data. What was non-farm payrolls like? What was the weekly jobless claims? What was the housing data like? What was manufacturing data, retail sales, etc. From there, we go into fund flows. Or fund flows, right? What was Lipper reporting? What is ICI reporting? What is what are commodity trading advisors? Are they leveraging up? Are they deleveraging? All that kind of stuff when it comes to fund flows. And we get into the earnings because it doesn't matter if you're in earnings season or not in earnings season. The earnings forecasts are always, ebbing and flowing throughout the year. So we take a look at what the up-to-date forecasts are, whether it's being delivered by FactSet, Refinitiv, Zacks Research, and then we give our investor takeaways. And our investor takeaways is really my synopsis and summarization of what's going on and what we are projecting. From Phenom Group's point of view, what we're projecting both in the economic picture as well as the earnings picture, because they both, come together at some point over time to deliver, an S&P 500 price target.
Sure. There's a lot going on at phenomgroup.com. I recommend people click on that link in the description below this video, or just type it into your browser, on your phone, on your laptop, whatever you got. phenomgroup.com. All right, so let's get into the brass tacks here about, I interview a lot of people and I work with people who are predicting a downturn. We had one late in 2018. We had a bit of a Christmas Eve surprise there. Not a good one. When Fed Chair Jerome Powell experimented with some Paul Volcker style fiscal discipline, didn't go too well. This year, it's just been up and up and up. What do you think is going to happen perhaps for the rest of this year?
Yeah, so we're up, let's call it 20% on the S&P 500, for the year, and up some 24% from the Christmas Eve bottom. We had actually, it was the middle of December last year in our weekly research report where I suggested, because I don't like to predict things. You never want to be the guy who predicts something, because if it goes against you, well, that was the guy who was wrong. So, but I do remember suggesting that we were near a trough. And the reason why I was confident that we were near a trough and this wasn't going to spill over into something, a 40% decline in the S&P 500 was because the macro data didn't point in that direction. There was a lot of things that came together in Q4 2018 to express that that bear market, technical or otherwise. It was a bear market. So we've rebounded, with the S&P 500 up 20% this year. We had a 7% correction intraday during the month of May. I would be of the opinion that we are on the precipice of another correction. How deep that correction will be, again, that's anybody's guess, really. But what I do is I look at a variety of data points, like I had mentioned earlier. I look at fund flows. I'm looking at what the earnings outlook is. What are the forecasts for earnings this Q2 period? I'm looking at commodity trading advisors' positioning, volatility targeting strategies positioning, hedge fund managers' positioning, and I gather all that up together. And I come out with, they're all releveraging higher. So they all have gross leverage has increased since June. Secondarily, it's not just that their leverage has increased, the length has increased, meaning the duration, that they've releveraged to. So it's not like they're just in this for the week. Okay. The positions that they're putting on are at least 3 months out. So any type of pullback that we are going to get is probably going to be garden variety based on that data. Now, that data can also change in the coming weeks and months, obviously. So it's all flowing. It all consistently flows throughout the year, throughout the quarter. But I'd be of the opinion that we are going to embark on a near-term pullback. I'm of the opinion a good 5 to 7% would be healthy, warranted, set us up for something, to advance the market higher in the back half of the year. We can't honestly look at a 20% return, through the first 6 months of the year and say we're only going to go higher. When, if we look at the macro picture, it's still very murky. And there's a lot that still has to be settled. The biggest component that I'm looking at really is capital expenditures. And they're awful. They're just awful. We see it showing up in the manufacturing data. Businesses are just not spending because their degree of certainty is down here. They want it to be up here to increase their capital expenditures. But right now it's way down here because they don't know when the next trade flare-up is going to be. They've already seen a flare-up or an escalation with China. We added tariffs, a percentage increase to the tariffs on China back in May, and then we threatened Mexico with more tariffs. Now, I'm not going to get into the whole political should we or shouldn't we thing, but from an investor standpoint, I can see what that has done to the business community. It basically puts them back on their heels So, because they don't know what their costs are going to be. Is it going to cost me an extra 5% to ramp up this production cycle? Or is it going to cost me an extra 10% to ramp up this production cycle for my manufacturers that I'm importing from, whether it's China, Vietnam, India, or Mexico? So you've seen all of this play out basically in the ISM, the Philly Fed Manufacturing, the Empire State, the Richmond, the Dallas. All of the manufacturing data shows you that businesses basically, kind of came to a halt in the month of May through early June, and they just. You see, the manufacturing data is soft data because it's mostly survey based, but eventually that bleeds through into the hard data. So that's the biggest overhang, when it comes to the economic outlook right now. But with all that said, 5 to 7% pullback, I think, would be healthy. You get a lot more people off of the sidelines. You look at the Bank of America Merrill Lynch recent survey, fund manager survey, and it shows you how big the cash position is. The cash holdings are for these fund managers. It's the largest position they have. You think they want to chase up here at 20% on the year? Probably not. You give them a 5 to 7% pullback, you've reined in the valuation, especially if earnings actually do grow. You've given them something of value. Earnings are growing, but the prices are cheaper. All right, let me layer in a little bit here.
Makes sense.
So
now, I know you don't want to get political specifically, neither do I, but there is an election coming up in November of next year, so it's a year and a few months away. I get the impression that the Fed and the president are going to try to keep this economic expansion or stock market bull market going at least until then. After that, I don't know if they care as much. Do they have the power to prop up the stock market until November of next year? Do you expect that to happen?
So the way that I've looked at the time period from when we imposed the first tranche of tariffs back in July 2018, I look at that period to where we are today, and I say everything that has brought about a curtailment in global economic activity has been man-made. These are man-made crises. These are fires that we're starting around the world. With trade, with sanctions, all of these are man-made, and eventually they hit the business sector, and we see it in the way of capital expenditures. The less that businesses are spending, eventually it's going to affect total, global GDP and of course our domestic GDP. So as we remove those issues or those headwinds, these man-made crises, we removed the man-made crisis for the Mexico tariff threat. We have a trade truce. How long that'll last, nobody knows, but it is something. So we remove, we input a trade truce. We have ongoing negotiations. It behooves the administration, the White House administration, to reach some kind of consensus with China ahead of an election year. Anything for a win, and we know that our president wants to win. Above all else, he wants to win. It's got to be the best. It's got to be the greatest. It's got to be the most. Everything is very, on the upper end of the spectrum for him. So that lends itself analytically to him trying to reach a consensus with China. I don't think we'll ever get some kind of grand deal. Why? Because there's no grand deal to be had there between what the U.S. party wants and the Chinese want. There's really no grand deal to be had, but we can find concessions that basically get us back to square one. And as long as you get us back to square one, and there is a document to go along with it, a treatise, something of that nature, the business community can relax. They will know what their costs are going forward, and all of a sudden, you unleash this pent-up demand. I think I tweeted out just the other day, we tend to think of pent-up demand at the consumer level, right? Because everything in the U.S. is about consumer spending. I think what we've failed to calculate or analyze here in this fiscal calendar year is that we have a pent-up demand when it comes to the business community, the B2B community. They want to spend. There's demand there. You can see it in retail sales. The end consumer demand is unaffected by all of this. So at some point, you can call it an artificial stimulus. You come to a consensus with China. There's actually documents that, say no more tariffs can be implemented based on these stipulations. And all of a sudden, the business community just starts ramping up production, manufacturing goes through the roof, and you get this just secondary boost in economic activity that most people aren't considering. So yes, you could definitely, if you're the White House administration, you could see another leg to this economic cycle and stock market out into 2020 that most aren't anticipating.
Yeah. All right. Well, I appreciate that, Seth Golden, all of your insight. And if people want more insights, of course, they're going to have to go to phenomgroup.com. Link is in the description below this video. So wanted to talk about your picks, maybe give people a little insight, at least right now, before they go to phenomgroup.com, of what you might be buying. Is there anything to buy? I mean, PE ratios are a little lofty right now. Are there any bargains out there?
Well, if you depends on who you listen to. If you look at CNBC or Bloomberg, all the rage right now is. If you read J.P. Morgan's quant analyst, his name is Marko Kolanovic, and he talks about the trade of a decade, or the opportunity of the decade being, this divergence that has occurred between valuing in cyclicals or value in growth, and you also see the divergence between large caps and small caps. So a lot of the narrative today that you'll hear on these media outlets is small caps are cheap relative to the S&P 500 or large caps. I can't subscribe to that, because we talk about small caps and whether it's the IWM, the small cap ETF, or the Russell, which is the Russell 2000, is mostly microcap, small cap companies, don't have earnings. But they're also, those indexes and that ETF, the IWM, is heavily weighted with financial sector, financial services stocks. And if we're going into, we're going into an easing cycle. That is going to put pressure on the financial services profit margins. So there's a reason why, we can look at charts and see divergences, but if we don't know fundamentally why the chart is reading this way, then we can kind of look at something and go, oh, it's very cheap. It's going to catch up. The IWM is going to catch up to the spiders or the S&P 500. But you got to look deeper and understand why it's happening. People are getting out in front, and they know an easing cycle is coming. So why would you own these financial services stocks? And the IWM is just loaded with it. It's something like 16% of the IWM ETF is financial services. So I can't subscribe to that thesis yet, that's the trade to be in. Don't get me wrong. I mean, if I'm wrong, I'm wrong. So what? But that's not where I want to be. I don't see the probability in that trade being very high. The risk reward is high, but the probability of achieving that reward, I don't think is high at this point. So I trade volatility. Volatility is the surest thing in the market, from my experience. Volatility goes up, I short it. Eventually, volatility has to come down. So, I trade instruments like the VIX Exchange Traded products, UVXY, TVIX, VXX. Those are my bread and butter. I have a core short volatility strategy that I've employed since 2012. Here in 2019, to our subscribers, we have over 100 trade alerts this 6 months alone. 6 months alone in shares of TVIX or UVXY short trades. And obviously, coming into this year, you heard everybody, oh, volatility is going to be even higher in 2019. It seems like when everybody's leaning to one side of the boat, the trade's over there. Yeah. So, that's kind of, my thesis when it comes to everybody talking about, the small caps catching up. If everybody's looking at that, it's very unlikely that that's going to be the ideal trading opportunity. So I short volatility. Going back to your question earlier, what do I think the market's going to do going forward? I think we get some type of a garden variety pullback that gives us a boost in volatility, and that's going to be my opportunity over the next couple of months to, again, layer on my short volatility positions, wait out the pullback, wait out the spike in volatility until it eventually decays. So that's my bread and butter. Other, individual stocks that I like and tend to trade a lot are the retail sector. I've owned Target. I've traded Target dozens of times, even this year. I think we've had 4 trade alerts on Target. It hit I think almost a 52-week high recently. It's trading at the upper end of its range. I bought it with you, David, I think in 2017 in the $50 range. And it's over $88. And I've collected a 3.5% dividend over the last 2 years alongside that. So it's been fantastic. Yeah. A lot of people don't like energy. I'm contrarian at this point. I'm a little contrarian to that. I actually think we are going to start uptrending in the energy sector. And I think there are names that are undervalued right now in that sector. We trade energy, but our main trade in energy was Anadarko Petroleum. And it stinks. Why? Because we made 30% on a trade in Anadarko Petroleum last year. It was a 3-month trade. It only took 3 months to, express that 30% gain. Here, in 2019, we bought Anadarko Petroleum. We traded it, I think, 3 times for about an 8% profit within a month. Right. And I decided, this is one I like. This is one I know. I think energy is going to uptrend this year. And it has, even though we've had this recent pullback, it has been in an uptrend this year. So I decided to hold some positions. Even though I was trading, I would usually extinguish all of them. I decided to hold back some. And then we get this headline that, I forget which company it was that was going to buy it out, and the stock shoots up. And, I get a 20% gain overnight. And, of course, you got to sell that, right? I mean, you don't hold on. You don't look that gift horse in the mouth. So I sold it, which means I have to go out and find another energy sector stock. So that's what I've done. I look at Devon Energy, Marathon Oil. Those are 2 that I like in the energy space.
Nice. If your biggest problem in life is that you had to take a 20% overnight gain, I think you're doing okay. Not too bad. Just real quick, I want to get your thoughts on this. Yield curve inversions. Sounds like you don't worry about those too much. It's not a big sample size, admittedly. But right. Whenever the 3-month yields more than the 10-year bond, talking about U.S. Treasuries here, you got to admit, it's at least a little bizarre that an instrument with a 3-year commitment is going to pay the lender more than a 10-year commitment. And that tends to precede, economic contractions, to be honest. It's happened recently. Right. I don't know. Is it meaningful at all?
I don't want to say it means nothing, but I don't want to overinflate the relevance. Why? Because we've never had central bank involvement to the degree that we have had over the last decade. And it's not just, our FOMC, it's the ECB, it's the Japanese central bank, it's the Chinese central bank, it's the German. So you have these central banks that have basically been suppressing, the upward motility at the long end of the curve when, what we know is all they can really affect is the short end of the curve when they raise or lower rates. So suppressing the upward motility or yield appreciation at the 10-year, the 30-year, etc., creates this artificial movement in yields, whereby it would be one thing if the 3-month was elevating and upwardly moving and then inverting with the 10-year.
Okay.
That's not what's happening. We have the 10-year moving down to invert with the 3-month. That's a different paradigm. That doesn't get talked about, very much in the media outlets or on Twitter and things like that. So, here's the other thing people don't like to hear. This time is different. But the reality is, when we talk about the yield curve and how it's inverting, it is different. And the reality is that the economic cycle is different. Every time we go into a recession, it's caused by something different, something new. So it's, in terms of the 3-month and the 10-year being inverted, it's not something that I believe will hold true to a recession indicator this go around. Especially, we're already embarking on an easing cycle. So when the Fed cuts rates, it's essentially going to uninvert the short end of the yield curve. Now, having said that, if for whatever reason you get some kind of bond vigilantism that decides, no, you can cut all you want. These yields are going up. They're going to stay up at the front end of the curve. Then we got a problem. Because it's one thing for the yield curve to invert. It's another thing for it to stay inverted. Because then you're talking about lenders just not being able to make money. There's their margins get crunched. So why lend? That would restrict financial conditions, and all of a sudden you'd see a tightening of credit standards, and that in and of itself would start to contract the economy. So I don't worry about it until I have to. And what I've just outlined is an unlikely scenario, but look, the things that we're seeing nowadays in the market, the things that we see going on in the economy, the feuds that we have geopolitically, I don't think anybody would have predicted these things 2-3 years ago.
Yeah.
So you can't count anything out.
Gotcha. All right. We're up to half an hour now. So as we wrap it up, what can we expect at phenomgroup.com? What's going on there? And do you have any, what are the different price points, let's say, for somebody who just wants to get in for a trial type of membership?
Yeah, so I mean, our best product really is going to be that weekly research report. I can't stress enough how accurate we are when it comes to forecasting. Okay, I don't want to say predicting. Forecasting the market and the economic data. We've been on point pretty much this whole year, well, ever since we started. So for $2.99, you get the weekly research report that gets sent to you directly to your email. You get the state of the market video that comes out every Thursday night. You get the first crack at it. You're talking about content that you can't find anywhere else. Literally, you cannot find 25 to 30 pages worth of research that tells you every single thing that's going on in the market and in the economy for $2.99 a month. Cancel at any time. We have a $39.99 trade alerts product as well. Now that gets you all of the other products alongside with it, but the premium membership for $39.99 gives you our trade alerts. It gives you access to our private Twitter feed where the trade alerts go out. Our investment ideas go to you. You get one-on-one coaching if need be, and you get access to our Monday through Friday live trading room. I mean, we have upwards of 30, 40 members in there on any given day. And we're talking about everything that's going on in the market in real time, trades that, people are putting on, what we're seeing in the data coming out. Oh, there's a headline, Donald Trump just made a tweet and, markets are moving. I mean, it's just really, it's a good forum for everybody dialogue, get feedback, and we have a morning market setup in the trading room to get you, pretty much prepared for what you could possibly expect throughout the day. And because we have a charting platform within the trade room, any technicals that you want to look at, maybe you want to look at eBay, maybe you want to look at IBM, we can bring up the technicals and run through all the technical analysis right there live in the trading room. And then there's a free basic membership, which basically gives you the daily market articles that we have pretty much Monday through Friday.
Fantastic. Those are all very affordable, and you get a lot for very small membership fees there. Fantastic. In any of those tiers that you mentioned. Fantastic. And if you could just tell us your social media handles.
On Twitter, it's at Seth, SETHCL, at Seth CL. That's my, most of the time I'm either on Twitter or on StockTwits, at Seth Marcus with a C.
Got it. And I'll put those in the link. I'll put those links all in the description below this video. All right, Mr. Seth Golden, full of insights and all the research you've done. You're bringing it out to the world and making it affordable. We really appreciate that. It's something that I think is a public service you're doing, so that's fantastic.
Thank you.
And you're welcome back here anytime. Mr. Seth Golden, thank you for coming on to Looking at the Markets.
My pleasure. Thank you.